Hey, beautiful people. Welcome back to Invested. Again, we're going back and reading some questions. I can see the market's not doing very well, the CRE market, because the questions that we're getting is a lot different than a couple of years ago. So the question here is, first, commercial. Please guide me. Need help with this deal. Hello, I'm a new commercial real estate personnel in a relatively decent area opposite to Walmart and other stores at the intersection. I was presented with the Sonic for sale. It's run by a multi-chain company with $40 million in revenue last year, so not a corporate lease. Below are the details. 6.57 cap rate at NOI of $144,900. 15-year absolute triple net built 2004. Rent increase 10% every 5 years. Is this a good deal? I ask because I'm reading elsewhere that if a Sonic doesn't renew, then I will have to demo and rebuild myself, etc. Please guide me. A good question, and I can see the nervousness because everything has risk, right? So in any investment, commercial real estate, fixed income, stocks, buying businesses, starting business, it always boils down to risk mitigation and how much risk you have an appetite for. That should really dictate how much return you're going to get. Simple math is more risk, more reward. Less risk, less reward, right? That's a simple guidance, right? So for the viewers here too. So multi-chain companies, so they're franchisees. So, there's a lot of franchisees who operate Wendy's. I'm not going to say their name, but these guys own 40 Wendy location, probably about 60 Taco Bells, things like that. So I know they're not corporate, but if they had that many food and beverage and stuff, their financials and their balance sheet's going to be pretty strong. So you don't have to wait too much about it. If it's not a one-off franchisee, they're okay. And 6.57 cap on $145,000 a year, triple net. That's what, about 2.25 million roughly. So that's about normal. And to me, I don't know where this located. If it's California, if it's Arizona, we don't know that. So I'm just using a broad 6.57 and that NOI they gave me. So a 15-year absolute triple net built in 2004. So I have to assume that 15 years started in 2004. So then I'm going to really have to understand when that 15-year absolute triple net started. So I'm going to give you a couple scenarios here. In that 15-year of triple net, if you are in year 2, that means there's still 13 years of lease remaining. I'm going to probably assume these guys probably burnt out 5. So most likely have 10 years remaining, because when you have 10 years of WALT, weighted average lease term, you don't get decompressed on your cap rate. You get the full value. If you start dipping below 10 to like 5, then the price gets discounted because of that risk of time of absolute dollars on the lease value. So in my opinion, it could be Sonic, it could be Wendy's, it can be KFC, it can be McDonald's. It doesn't matter. There is a certain element of risk. So is that risk equal to what your returns look like, right? That's what you're trying to get out of it here. So how many years is it remaining? If it's going to be more than 10, that's okay. That's on the positive side. 10% every 5 years, that's pretty typical of most national guys, national tenants. It could be even for AutoZone, that's what they're going to have. It's not going to be a subway inline space where you're trying to get 3% annual escalation every year in a grocery anchor, shopping center. These single tenant net leases are going to be about 10% every 5 years. That's pretty standard. Annual escalation is always better, because think about it. If you get 10% every 5 years versus you get 2% every year compounding, which one has better return? So most likely landlords want that compounding of annually, but these national guys usually standard is 10% every 5. So that's not really alarming. The question is, if Sonic doesn't renew, so now the question goes back to, if you have like 5 years remaining, it gets a little bit more riskier, because after that 5 years, I'm sure they're going to have option to renew at a fair market value or a pre-conscribed number of 3% or 10% on the renewal term. But the question you should be asking is, how profitable, how good is Sonic? Is Sonic a viable company? I mean, if you go there to Sonic at that location, is their drive-throughs just packed during, busy lunch hours or dinner hours? If those are good, and if it's at a cross street where there's a Walmart, I have to assume VFD on those main crossroads are going to be pretty robust. I wouldn't see Walmart going into a corner where there's less than 30,000 VFD, vehicles per day. So even if the Sonic went away, you're saying you have to rebuild it myself. That's not necessarily true. There might be some residual value where another national firm may want to take that and utilize it, depending how good the condition or the layout of the current spaces. I know Sonic's a little bit different. Their drive-through concept is a lot different than Wendy's or traditional Carl's Jr.'s of the world, right? So you might have to rebuild it, but then you can ground lease that to a national chain to develop their own. So long as you can, forgo a year or two until you get another national tenant for 15 years. If that is viable for you, then I don't think this location is that bad. The pricing 6.5 cap, that's about right. But if there's really about 5 years remaining, you don't have to wall, that might be, in my opinion, slightly elevated at one of the higher ranges. I would look at it closer to 7 cap. Now, if they have a full 15 years remaining and is guaranteed by that corporation that has $40 million in revenue last year, 6.6 cap is about the right price. So I think the question is this a good deal? Please guide me. So I'm going to guide you. Number one, you should look at your due diligence a little bit differently. If that cap rate and the price is market, that is in line with the market. The question really lies down to the operation and the brand of Sonic. There's not too many Sonics in California, where I am from, right? So is that a viable company? It might be in that region. And if they've been there successfully for the last 15 years or 10 years, whatever it may be, what catalyst is there that they are not going to be viable? Is it higher taxes? Is there no population growth? Are there businesses closing in the area? I mean, that's going to be more alarming for you. But if there's a Walmart, I never seen Walmart go out of business or close their stores unless it was an older product and they have the superstores. So you have to really physically look at the neighborhoods, the demographics, how much vehicles they're going through. Are they busy doing usually traditional busy hours? You might look at the P&Ls, even though they have a 15-year absolute triple net. Look at the current lease or the ground lease they have with the current seller. In that lease, does it stipulate that Sonics have to give you their annual sale or monthly sales? If that's the case, you could look at their sales history and see if their sales are going up annually. Are they staying stable? Or have they been declining throughout the years? So that's going to ultimately go into your analysis of risk reward. That's how I would look at it. That's how I'll guide you to do so. But forget about the deal itself. Unpack that deal, go a little bit deeper. Underwrite Sonic, underwrite the location. If they moved out, even though you have to rebuild it, are there other operators or chains that want to come into that location? If that's the case, your risk is highly mitigated. And I hope that information was helpful for you. There's a lot more we can talk about, but I wanted to keep it to what you asked for. And if you have additional comments after watching the video, please add comments and we'll get back with you. If you found this content helpful, please like, subscribe, and follow. Thank you very much.